$98.52 showed up in my account 2 months ago. I didn't work overtime for it. I didn't sell anything. I didn't even log in to do anything. I woke up, checked my phone, and there it was, just sitting there like someone Venmo'd me out of nowhere. Except it wasn't a person. It was my SCHD investment paying me again. The payments keep growing every single quarter, completely tax-free because I'm doing this inside an HSA, and by this time next year, those deposits could be hitting $120 or more. The Schwab US Dividend Equity ETF, basically, it's a fund that holds about 100 of the best dividend-paying companies in America. Pepsi, Cisco, Verizon, Home Depot, the boring stuff your parents probably own. But here's the thing that blew my mind. This fund has consistently increased its dividend payment every single year since it launched in 2011. Every single year. So I did what any rational person would do. I invested, and now I have 400 shares total at around $27 per share. My total investment is $10,957. Was it scary? Absolutely. That was money I had sitting in my health savings account. But I figured if I'm going to let money sit there for the next 20 or 30 years, why not let it actually work for me? My first dividend payment came in September 2024, $9.10. I'm not going to sugarcoat it. I was disappointed. But then December, $37.80. Then March, $64.40. June, $87.99. And just last September, I collected $98.52 from SCHD alone. That's about $298 in dividend income over the past year from an investment I made a year ago. And this is all inside an HSA, which means it's growing completely tax-free. No capital gains, no dividend taxes, nothing. The government isn't touching a cent of this money as long as I use it for qualified medical expenses down the road. But here's what really keeps me up at night in the best way possible. My current value is sitting at $11,054. My total paper gain? $97? Yeah, you heard that right. After all this time, I'm only up $97 in actual share price appreciation, and you know what? I don't care, not even a little bit. Because while everyone else is obsessing over whether their stocks went up or down today, I'm watching real money hit my account every 3 months. Money I can reinvest, money that's buying me more shares that'll pay me more dividends. It's this beautiful snowball effect that compounds faster than you'd think. Now, before you think I'm some SCHD cult member who only buys one thing, let me tell you about the other side of my portfolio. I've also got money in FXAIX, that's Fidelity's S&P 500 index fund. 53 shares with a cost basis of about $207 per share. Total investment, $11,083. Almost the exact same amount I put into SCHD. But check this out. The current value is $12,687. My paper gain on FXAIX, $1,603. Let that sink in. Same amount of money invested, one's up $97, the other's up $1,600. So here's the question that's been eating at me, and I genuinely want to know what you think, because I'm torn on this. Should I care more about the gains I can see or the income I can touch? FXAIX pays dividends too, but they're nothing compared to SCHD. I got $24 in December, $25 in April, $31 in July, and $34.18 this past October. Total dividend income from FXAIX over the same period, about $114 versus SCHD's $298. But FXAIX is crushing it on growth. That $1,600 gain means if I sold today, I'd walk away with significantly more profit than SCHD has given me in total value. The S&P 500 has been on an absolute tear, and FXAIX is riding that wave. Meanwhile, SCHD has been kind of flat, just steadily pumping out those dividend payments quarter after quarter. So this is where I'm curious about your perspective, and I want you to drop a comment because I'm trying to figure out my next move here. If you had to choose right now, today, with your own money, would you rather have that steady, predictable dividend income that keeps growing every year? Or would you rather have the capital appreciation and growth potential that comes with a total market index fund? Because here's what keeps me up at night. What if the market corrects 20% next year? FXAIX would take a massive hit in value. I'd watch that $1,600 gain evaporate, maybe even go negative. But SCHD, those dividend payments keep coming. Companies like Coca-Cola aren't going to suddenly stop paying dividends because the market had a bad quarter. If anything, during corrections, I get to buy more shares at a discount with my dividend reinvestment. On the flip side, what if the market keeps ripping for another 5 years? FXAIX could double. That 11 grand could turn into 22 grand, while SCHD just kind of trudges along, paying me a few $100 every quarter. I'd be sitting there watching everyone else's portfolios explode while I'm clipping dividend coupons like it's 1985. But the HSA angle is what makes this whole thing even more powerful. Most people treat their HSA like a glorified savings account for medical bills. They contribute, they spend it on doctor visits, rinse, and repeat. But if you can afford to pay for your medical expenses out of pocket right now, you can let that HSA money grow tax-free for decades. And when you're older and inevitably have more medical expenses, you've got this massive war chest of tax-free money ready to go. Think about it. The average couple retiring today is going to spend around $300,000 on healthcare throughout retirement. That's not a guess. That's data from Fidelity. 300 grand. If I can build my HSA up to that number or close to it over the next 20 to 30 years, I've essentially created a tax-free healthcare fund that covers one of the biggest expenses in retirement. And I'm doing it by investing in solid dividend stocks and index funds instead of letting it rot in a money market account earning nothing. Now let me be real with you about the downsides, because it's not all sunshine and dividend checks. SCHD is heavily weighted toward financials, industrials, and consumer staples. You're not getting the next Nvidia or Tesla in this fund. If tech continues to dominate the market like it has for the past decade, SCHD is going to underperform. There's no way around it. You're trading explosive growth potential for stability and income. Also, dividend investing requires patience. Like a lot of patience. This isn't a strategy where you see results overnight. It's not even a strategy where you see exciting results over a year or two. This is a decades-long game. The real magic happens in years 15, 20, 25, when your dividend snowball has gotten so big that it's throwing off serious income without you having to do anything. I'm not sitting here telling you I've got it all figured out. I'm not some finance guru with a course to sell you. I'm just a regular person who got tired of watching money sit in accounts doing nothing while everyone else seemed to be building something. The question I keep coming back to is this: at what point do you shift from accumulation to income? Most financial advisors will tell you to go all in on growth while you're young and then shift to dividends and bonds as you get older. But what if that's backwards? What if building that dividend income stream early means you have more flexibility and less stress later? What if starting the dividend snowball now, even if it means sacrificing some growth, gives you options in your 40s and 50s that other people don't have? I don't have the answer yet. Maybe you do. Drop a comment and tell me what you'd do with these two positions. Would you keep them balanced? Would you go all in on one strategy? Would you do something completely different? Because honestly, I'm figuring this out as I go, just like everyone else.